We are back on MorningLine. Thanks for joining us. Yeah, at first you're thinking, maybe I'm a guest on Retirement Report, but that's on Fridays. Hank Parrott's with us, and it's good to have you on, sir. And when we thought about we need to do a program on what's happening with stock market, we immediately thought of you, of course. And so we can take some phone calls, 737-7587, about what you see going on in the market. And you've heard about the market dropping so much. What are you hearing? You don't get a lot of calls, you said, from your clients because they're confident in what they have set up in themselves. But what should someone right now who's concerned about their investments seeing this be doing or not doing?
Right. Well, the biggest thing is this is the time to reevaluate your current portfolio. Understand, again, it's asset allocation. So it starts with you should have a mix of stocks, bonds, and cash. A little bit in a money market account as an example. All right. One of the things that goes with this, when it comes to your stock portfolio portion, all right, you've got stocks. You want to make sure that those stocks, you have small companies, large companies, international, domestic. Again, this diversified portfolio. And actually, there's a science to this. Dr. Eugene Fama won the Nobel Prize in 2013 in economics for his equity research. He developed what's known as the three-factor model. It's been expanded out to now the five-factor model. And he determined certain things within a portfolio that made the difference where you could get the most return with the least amount of volatility. So if you imagine the S&P 500 index, this is the 500 largest companies. They make up 70% of the equity, the money that's in the stock market, just these 500 companies. Out of all the thousands of companies, 70% there. Right? The index outperforms over 90%, according to Tony Robbins in his book. In fact, on his research, 96% of equity mutual funds. So that means if I just buy that index, I'll be fine over the long term. But now there's the key, the long term. See, time is the other part that you got to take into consideration. So if you're in your 30s and 40s and you've got a portfolio that is properly allocated, you're not going to worry about this volatility. And if you have it, if you use the principles I'm talking about, and I get into in the book how the smart money invests, because I talk about Dr. Fama's work even back then before he won the Nobel Prize. All right, we were well aware of his work, and it will tighten up that volatility and yet still get you that desired rate of return. So an example would be if you look at Markowitz's efficient frontier, a moderate portfolio which might have 50% in stocks and 50% in bonds, when properly allocated, will get you a return long term comparable to the S&P, but with about half the volatility.
Not as much risk. Okay.
All right. So you're going to have, if you know that, and here's another part. When the S&P, as an example, 2000 through 2002, the S&P drops over 40%. It was like 44% over that period. Took about 5 years for it to recover. All right. Then we hit another bear market. In 2000, from October of 07 to March of 09, the market drops 55%. All right, takes again about 4 or 5 years for it to recover. The portfolios I'm talking about, a moderate portfolio over the same period, in the first 2000 to 2002 period, it was like at about a break even. Didn't lose 40% like the S&P. So obviously it was only down a couple of $1,000s on a $250,000 investment, and so it rode that out really smoothly. Made money, and then in 08, when everything dropped, it only dropped about half what the S&P did. So and they bounced back in about less than half the time. In say 12 to 24 months, you've recovered even from a bear market period.
I want to ask you about the bounce back in a second, but let's take a phone call or two, and let's go to Mark. Mark, good morning.
How you doing today?
Hey, Mark. How can we help you, sir?
I have one question. How does the 10% rule work in a downturn like this? Do you go ahead and implement that on your individual stocks, or do you just ride it out?
When you're talking about a 10% rule, are you talking about when they're talking defining a correction as a negative 10%?
When the value of your stock drops more than 10%, and you know that your cost, if it goes down 10%, they say you should sell during normal time. No,
it basically has more to do with the actual holding. All right, as an example. So you have to look at the value of the company underlying. So if the book value of the stock is still, if that drop still keeps it, say, at or below its book value, then I wouldn't be as nervous about it than if it was selling, if I see it selling well below book and it's starting to correct like that, well then, yeah, maybe that would be more of a concern. The other things are what's going, if you're talking about an individual company, what's going on with that individual company? All right, is there something that's causing that stock to drop? Is it more systemic where it's just that it's going down as the whole market is going down?
Does that help, Mark, or what are you doing in this situation right now with the market over the last few days?
Well, I've got both mutuals and individual stocks, and I think you just stand back and watch it. You know.
Are you a day trader also? Do you do day trading?
No. What I've done, I do believe in spreading it across all types of stocks. You know, I'll have everything from industrial stock to entertainment stock, that type of thing. I don't try to put all my individual stocks in one sector.
Yeah.
And same thing with my mutuals. I've got bond fund. I've got international. I just got to try to keep it spread out. I don't want to put everything in one place. So you'll get.
Here's one of the things I would recommend to you, Mark, when you're looking at your portfolio. Take a look and see if you've got any overlap. When you're talking about diversification, in particular it's mutual funds, you can have like 10 different mutual funds, but they may all hold many of the same things. So you got to be careful with that. And even though it might say large cap as far as the type of fund, the money manager that's running that may in fact start buying mid caps, and it may skew your asset allocation quite a bit.
I notice you have to really watch that and move them around.
And it's watching. Well, one way that you can get around the moving it around part, and it'll save you a lot on trading costs, is look at indexing or institutional funds. They're not going to change like that. When you buy a large cap, like if you buy an S&P 500 index fund, you know you're going to have those 500 companies, and the only time that's going to change is if the index changes. Right. If you have a large cap institutional fund, like a DFA as an example, same thing. You're going to have a large cap. It's going to do even better, by the way, than the index over that period in the way that they work. But there again, you're not going to have to worry about that messing up your asset allocation. One other caveat, if you will, when you're looking at your bond funds, be very careful there, in particular with active managers, because one of the things I'm seeing more and more when new clients come in is that there's a lot of junk in their bond portfolios. And by junk, I mean that they're B-rated or low, like less than A-rated. They're not investment grade. They're B-rated bonds. Some may be, triple B, double B, single B, worse. And they're also longer durations. I'm seeing bonds that are like 15, 20, 30-year bonds in a portfolio. And as we know, with the Fed poised to raise interest rates, that's going to really hurt those bonds, especially the low quality and the long duration bonds. So you want to stay short term right now, even though you're not going to get as much return in the short term.
Yeah, I've only got 17% of my stuff in bond fund right now. So
you're being a lot more aggressive than on your equity portfolio. So that's going to subject you to more volatility in a market like this.
Oh, yeah, but you can ride it out.
As long as you got the time, exactly right. As long as you got time and you watch your asset allocation, again, keep your mix in there, then you're right. If you got 10 years or more that you can let that ride out this volatility, you should be fine.
Great. Thanks a lot.
Hey, Mark, thank you. Great call. And the line's open, 737-7587. That was very interesting. You did mention something about the interest rates. And we're hearing that the Fed's going to meet maybe in the next week or two, and perhaps for the first time in how long consider raising the interest rates?
No, they've been putting out there for some time. We're going to, we're looking at September as being the time that we might raise interest rates, and by how much, most people are saying, an eighth to a quarter, depending. And now there are those that are concerned. Well, is the Fed going to look at what's going on in the market and be, more reticent, maybe postpone that because they're worried that it might create some negativity in the market? Personally, I think it's time to rip off the Band-Aid. Let's get it done.
I mean, because with the interest rates, people have been putting, maybe you can explain this to me. I was trying to muddle through it this morning while I was watching some of the programs and reading. By having these super low interest rates, how does that affect individuals' ability to invest? Is it good or bad to have low interest rates? Well,
the bad part about investing or about low interest rates in general is, first off, if I want to be safe, all right, so I'm retired, I want to corral in and, reduce my volatility. I don't want to take a big hit right now. This is my nest egg. I'm not out there going to be making and pumping money into it anymore. Now I'm on a fixed income, and this is, whatever I'm able to pull from this, maybe supplementing that income. So I've got to be more careful. What's the downside? Well, if I can't go, what do I do in a CD?
Yeah,
one-year CDs, right? 30 to 50 basis points, maybe, right? I'm not getting anything there, and even a 10-year CD is like 2.3%, 2.2%, similar to what a Treasury might be. Well, who wants to tie up their money for 10 years for that kind of thing? And in particular, when we know we're at historic low interest rates, and they're going to go up.
So instead, people were doing what with their money if they weren't tying it up?
It's forcing them to have to go out and take risks they would otherwise not want to take.
Which could maybe artificially, not artificially, but inflate investment in the market with people that really don't want to be there.
And maybe don't quite understand.
Yes.
So they're going out and they're saying, I don't want to put it at risk, so let me go with bonds because bonds are less risky than stocks. Well, guess what? Short-term bonds aren't paying anything either.
Nothing. So
then what do? Well, I'll get, this guy will pay me more interest. Well, that's because this guy can't borrow the money for less.
Yeah.
So that means the low quality. There's your junk bond status, okay? What's the other thing I might do? Well, if I loan it to the person longer, they'll give me a higher interest rate. But now I'm tying my money up again to get that higher interest rate, so when rates go up, I try to get out of it to capture the higher rate, and I'm going to have to sell at a discount or a loss.
You suspect they will raise the interest rates?
No one, no one knows what the Fed's going to do.
They're going to look at it.
I don't even think the Fed knows what it's going to do half the time until the day they meet, right?
All right, we'll take a break on that note. When we come back, more of your phone calls, more of our conversation with Hank Parrott about what's happening in the market and your money. 737-7587. Back right after this.